Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duc with Tri-City Equity Group. Today we have Brian Burke on the show. I saw him talk at Duc Live in Dallas. He's the CEO of Praxis Capital, a vertically integrated investment firm with thousands of multifamily units under management worth over $500 million. With me is my co-host, Vince Geppings.
Hey, Duke. Super excited about this call with Brian. I've been following him for a while on LinkedIn, and very, very high level investor with years and decades of experience under his belt. So I'm super grateful to have him on the show, pick his brain about some things. Big things to take away from here that you're going to want to listen in is, things like importance of having reserves as a sponsor, being vertically integrated, how the evolution of that concept, his plan that we got from his book, the buy and watch method is one of the things that one of our takeaways from his new book. Being conservative in your underwriting has been able to keep him from never losing investor money. And he goes into some detail on some of the things he does in his underwriting and his team and the experience and value he adds to the market and to his investors for that. Go over some unique resident programs, incentive programs that they use that have been yielding great results. And then also a few book recommendations as well to expand our education.
Welcome to another episode of the Cash Flow Project. Today we have a very special guest, Brian Burke. Brian is the CEO of Praxis Capital, a vertically integrated real estate investment firm. He's acquired over $500 million worth of assets over the span of 30 years, including thousands of multifamily units and over 700 single-family homes. Brian most recently wrote The Hands-Off Investor, which covers syndications from a passive investor perspective. Brian, welcome to the show.
Hey, thanks for having me on. I appreciate being here.
So I saw you talk at Duc Live in Dallas last year, and I learned a lot about your approach to asset management. I was especially impressed by your not losing investor money over your long career. So for those who aren't familiar, tell us a little bit more about what you do and what you're working on now.
Yeah, I'm the CEO of Praxis Capital. We're a vertically integrated real estate investment private equity firm based out of Northern California, north of San Francisco. And we invest primarily in multifamily apartment units in several states across the country. Right now, our portfolio is in Arizona, Texas, Georgia, and Florida, and growing. And you're right. I think the thing I'm most proud of is that 20-something years of using investor money to acquire real estate through how many market cycles have we been through and haven't lost a nickel of investor principal is something that we're very proud of and a trend that we don't want to reverse anytime soon.
Yeah, super inspirational. So what is your why for building passive cash flow?
Well, it's certainly not passive for me. I'm the one doing all the active work. So for me, this is absolutely an active business, and I have no passive cash flow in it whatsoever. But my motivation is to provide that passive cash flow for people. I really enjoy what I do, both from a real estate perspective and from an investment perspective. It's I just can't imagine myself doing anything else, and I'm probably not qualified to do much else anyway.
So I know you have a ton of experience in the syndication space. So let's go back to the first multifamily deal that you sponsored as a GP. So how did you find it and structure it?
Well, my very first multifamily deal was one I actually bought on my own out of a 1031 exchange. And I did several multifamily deals on my own before I ever did this raising money from other investors. I had to kind of, perfect the model, so to speak, before I would go out and raise money from people. So the first larger multifamily syndication that I did, I'd probably done, 200 single family deals by then, including several blind pool funds and the several multifamilies of my own. But it was a total disaster. And, it was a property I bought in 2009, right after the real estate collapse. Had seemed like we had seen the worst of it. I bought the property for half of what the guy before me paid when he bought it. and thought that that was like absolutely brilliant. But what was really stupid was, I had a lot of leverage, more than I should have. And I didn't really understand the enormous impact that an adverse economic climate can have on income property. And as a result, we bought the property with like 80-something% occupied. I fixed it up. I did a whole set of exterior repairs, started renovating units, raising rents, building occupancy. I got it to like 99% occupancy. It was like we were home free. We did everything right, and we did it in like 4 or 6 months. And then that lasted about a week, and then the bottom just dropped out. And that's when you might recall seeing on the news, Bear Stearns collapsed, Lehman Brothers collapsed. There was a run on the banks. It was a total mass chaos out there. Jobs were getting lost left and right. All the job losses resulted in move outs, skips, evictions, failures to pay. And, it was a complete nightmare. We ended up, I used to joke, I'd say, half the units are empty and the other half aren't paying. and that's about how bad it was. It was pretty bad. And, the property wasn't making enough money to service the debt. It was making enough money to just pay the expenses. No money left over for debt service. So I reached in my own pocket. I paid $15,000 to pay the mortgage payment out of my own pocket, and figured, that would only happen for a month or two. But that went on for about 4 years, where I paid this $15,000 a month payment out of my own pocket, until finally the economy came back, and, values came back, and renters came back, and lenders came back. And we were finally able to sell the property and make enough of a profit to return all the money I loaned interest-free into the company to make the mortgage payments, enough money to repay the investors all of their initial investment, and even give them a single-digit return. So, it really was a total disaster, but it kind of turned out it was probably the best outcome we could hope for, given the circumstances.
Got it. So did you exit that deal already?
Yeah, we exited that deal about 4 or 5 years ago, and it's one of those things where people ask, like, what was the worst experience or worst deal you ever had? That's the example that I give them. And it's funny because that was my first larger multifamily syndication. Certainly I'd done a lot of other syndications in the past, but on a larger multifamily, it was one of our early ones. And boy, I got jumped in, man. It's talk about getting thrown into the shark pool.
Yeah. So how does that environment compare to now with COVID and all that?
It's a little bit different, but in some ways similar. We're seeing the dislocations in the market now. I think today's climate actually reminds me a lot more of Hurricane Harvey than it did of the Great Financial Collapse. In Hurricane Harvey, it hit Houston about 3 or 4 years ago, and we own some property there in Houston. We didn't get damaged in the hurricane, but the hurricane caused all kinds of economic issues. So first thing that happened, of course, all the roads were flooded, so people couldn't go anywhere. So everybody was kind of locked down, which sounds familiar, right? The other thing that happened was people were losing their jobs. They were losing hours, which also sounds pretty familiar to what's going on today. And then the next thing that happened was the courthouse was damaged in the flooding. And because the courthouse was damaged, they couldn't process any evictions. So just like today, we have eviction moratoriums. Well, back then there was a de facto eviction moratorium because the courthouse was closed due to the damage. So we had job loss, income loss, no evictions, shelter in place, basically, because you really couldn't go anywhere on flooded roads unless you had a rowboat. And that's kind of like, in a lot of ways, similar to what we're going through right now. And it happened very suddenly and quickly. But we had about 18 months of fallout as a result of Hurricane Harvey, where it was very challenging to rent units. We had high evictions and skips, high bad debt, high concessions to refill units. We had occupancy challenges and all of those things, which are things that I think we're probably going to see as a result of the COVID issues. We haven't really seen it yet. So far, people have asked, when's the other shoe going to drop? And I think I say, when is the first shoe going to drop? No shoe has dropped yet, but it's coming.
Got it. So when do you think we'll start to kind of feel some of these effects from, tenants skipping and bad debt and that kind of stuff?
My guess is August or September, and it really depends upon when the federal government ends the $600 a week bonus unemployment benefit. Right now, it's scheduled to run through the end of July. The question is going to be, does it get extended or does it not? And that's really going to be make a big difference, because make no mistake, it's a benefit for the unemployed, but really, in a sense, it's a stimulus package for landlords, because, assuming that tenants make the right decisions, they'll be using that extra money to pay their rent, which is really what the intent was, is so that people wouldn't get behind on rent and lose their apartments or homes and that sort of thing. The majority of our residents make, kind of in that $30,000 to $40,000 income bracket. I think the most expensive rent that we have in our portfolio is around $1,400 a month. And as a result of those dynamics, a $600 a week unemployment benefit means that most people are making more money on unemployment than they are when they were working, at least in our income bracket of our tenant base. So far, it's sheltered us from a lot of the negative impacts of what's going on, in the macro picture. But if that faucet gets turned off, then things could change quite a bit for us.
So have you had to make any adjustments to your asset management practices or anything like that?
We did a lot of things. When this first happened, we got ahead of it very, very quickly. The first thing we had to do was, remind people that despite the fact that there's chaos in the world, you're still responsible for paying rent, and set that expectation, but at the same time, convey the message that we're on their side and we're here to help. And if they've experienced job or income loss as a result of what's going on, that they need to let us know. And if they let us know, we'll do our best to work with them. And one of the things that we did early on was, we understand that this is really a human business, and it's, a human to human. If people get an unemployment benefit or a stimulus check from the government, it's up to them how they spend it. And, we want to make sure that people pay bills because they want to. I mean, we know they have to contractually, but really what it comes down to is, do they want to? So what we did is we implemented a practice where anybody came to the office and told us they had experienced job loss as a result of COVID, we were giving them a $50 gift card to the local grocery store. A lot of our other landlords that we talked to were rewarding people for paying their rent on time. We took the opposite approach and instead gave people, a hand up if they couldn't pay because they had experienced income loss. And, in one hand, it helps them out, but on the other hand, it also, helps to build that alliance between, owner and resident, that we really are here to help. And, when it comes time for them to decide which bills to pay, hopefully they'll choose ours because they knew that we were there for them in their time of need. So that was really kind of the main thing that we did. And it's amazing how many promise to pays that we had. Our collections held very solid. April over March was up 4%. We had some properties that collected record income in April, and May was on track equal to April. So I think the practice was working.
Wow. It's that law of reciprocity going into effect a little bit.
Absolutely.
Yeah. So in the hands-off investor, you mentioned the buy and watch strategy. Can you elaborate on that?
Yeah, people always ask me what kind of an investor I am, because when I first started out in this business, I was a buy and flip investor. I would buy it, fix it, and sell it, buy it, fix it, sell it, and just keep doing that over and over and over again. And, so we got known as like the buy and flip guys. And then, we started holding portfolios of rental homes. We'd start buying houses and hold them, for years as rentals. And then it's like, are you a buy and hold guy or a buy and flip guy? And so, our motto on the apartment side is we're neither of the two. I call myself a buy and watch investor. And what that means is we buy the property, we improve it, we do everything we can to improve the income stream, and then we watch the market for the right time to exit. And the market always sends signals. So we're always monitoring those signals to determine when is the right time to exit. So, are we a 3-year holder, a 5-year holder, or a 10-year holder? That's always the question. And we always prepare our investors that, hey, this is going to be a 10-year hold or up to a 10-year hold. But our philosophy is we sell in 3 years if we can, 5 years if we need to, or 10 years if we have to. And the market is really in control of when that is. The sooner we can do it, usually the better we can deliver returns and that sort of thing. So we try to get in and out sooner and lock in those gains, but can't always do that. The market really is in control. And, you know, there used to be a commercial years and years ago that said you can't fool Mother Nature.
We have a very similar philosophy in our company, like the 3 to 10 years. And it's like, hey, I think we said we table it. We have these tabled milestones like, hey, at 2 years, we'll put on table and see how we're performing on our business plan. At 3 years, that's when we start talking about maybe a refinance or our first exit if the market cap rates are going down, and so on. And then the 5 years, our target, ideal hold, and then 10 if we have to wait for a cycle to start coming back up. But yeah, we have very similar in that. So switching gears, so Praxis Capital, as you mentioned, is a vertically integrated company. Most companies don't start vertically integrated. So can you tell us what departments or capabilities or branches or arms or however you define them that you have in-house, and what ones do you still have that you hire out? What functions do you still hire out?
Yeah, and make no mistake, we didn't start out as vertically integrated either. It's something that you grow into. I mean, it doesn't make a ton of sense to go vertically integrated when you're first getting going and that sort of thing, because there's really talented resources that are out there that are available for hire that you should take advantage of until such time as you need to bring it in-house. So for our first 20 years, or more, almost 25 years, we didn't have that vertical integration. In some roles we did when we were house flipping. After the economic collapse in 2009, we were flipping like 120 houses a year. And we went vertically integrated in that space by creating our own construction company and bringing all that stuff in-house. Well, on the multifamily side, we were using third-party property management companies to supervise the real estate, oversee renovations and all that. We changed that about 4 years ago, where we created our own wholly owned property management company. We don't manage third party for other operators. We only manage properties that are in our own portfolio. And we did this for 2 reasons. Well, 3 reasons really. One reason is that we have more control over the entire process from start to finish. So that's the operational side. The growth strategy side was that we recognized that in order for us to grow and scale to the size we wanted, we needed to have institutional capital partners that could write really big checks to help us acquire larger portfolios of properties. And we found that the institutional capital providers and JV equity sources like to see sponsors that manage their own portfolio and have that vertical integration. So in order for us to capture their attention, we needed to have that component in-house. So that was the second piece. And the third piece was that it was somewhat opportunistic. And, sometimes when there's a person available that has enormous talent, even if you don't need them yet or want them yet, sometimes it pays off to grab them. And this is one of those cases where it was just like the right timing, where the right people were available. And I was contacted just by stroke of luck of a friend that was looking for an opportunity. And he and 2 other colleagues who had been kind of, friendly competitors over the years, wanted to join up with another firm. And they contacted me, and one of the guys on this team was an expert in starting national multifamily footprints and had done it for institutional owners 6 times in his 40-year career. And between these 3 guys, they had 100,000 units of multifamily experience. So I said, well, this is a real opportunity. If I can get these guys to join this company, we could create our own management company, and I have just the people here in front of me to run it. and really help us scale on a more nationwide basis. So after months of prep, we ended up with all three of those guys joining the firm, and we created our own management company and never looked back.
Wow. So that's an incredible story to have that, like I said, being able to spot that opportunity. Yeah, so in my head, I picture like businesses like this, like growing in like almost like a staircase. Like you have a big growth portion, and then you kind of plateau. And then as a CEO, you have to start asking yourself questions like, okay, we hit a ceiling, we hit, we stagnate a little bit, like we need to grow more. And then you kind of keep going up in that staircase of being able to like ask the questions like, okay, now we need to go bring management in-house, or now we need a construction company in-house to give us that capability, that efficiency. So that I think it's very important for our listeners to like being a CEO and being able to ask those questions, like constantly looking at your business and process and spot those opportunities it's not easy, and it always requires a hands-on. So it's awesome that you're able to spot that opportunity. Because it always seems like, it's just the chance interactions, but then how many times did interactions like that happen with other people and they weren't able to spot it, that opportunity of bringing a team on like that. So that's really awesome. So what are things that you still hire out? Did you answer that? That you said property management. Are there still things that you're like, let's let the experts do that? We're not there yet, or they're just better at handling some things, the third party still?
For the most part, we handle the whole process A to Z. So now that we have our own management company, we have a vice president of renovations who is in charge of our construction arm that supervises the renovation of all of our apartment units. We have a corporate controller who supervises the accounting section. So we have pretty much everything in-house. The only things that we still kind of sometimes we'll third party out some construction functions. If we have a ton of renovations that we're doing, we might hire a painting contractor to come in and do all the paint work, to help us speed things along. So a lot of construction resources we'll still use third-party vendors. We use a third-party vendor as a property tax consultant to help us challenge and manage all of our property tax assessments. We use a large accounting firm to do our, I think, 52 tax returns that we have to file every year, and almost 1,000 K1s that we send out every year. So they generate that for us. So, some of those basic functions, yes, but everything else, we have all the talent right here under our roof.
That's awesome. So for Praxis tagline is recognizing opportunity, delivering results. What are some examples of the value add opportunities that your team can recognize that other investors overlook? Like what's your competitive advantage at Praxis?
Well, our competitive advantage is that we've always had the ability to acquire the right distressed assets. We've been in the distressed asset business for 30 years and have a real distinct advantage. Just that experience in real estate and having done over 700 acquisitions, we've kind of got the acquisition side of it figured out. We have the 100,000 units of multifamily experience, which gives us a tremendous leg up in operations and making sure that we can streamline operations and make really good decisions, even in the face of stormy weather. But here's an interesting example I'll give you. Is a property that we bought in the Atlanta market about a year and a half ago. There was a property that it was actually listed. Most of the stuff we buy is off market, but this one actually came on market. We really liked the property. We put in an offer. We were awarded the deal. And then while we were kind of in that negotiation phase, the property next door came on the market. And so we put in an offer on that one as well, ended up getting it. The upside of the story was when this property was built, it was one property at one time. And then somewhere along the line, somebody put a fence across one of the connector roads and turned it into two properties. So you had a 255 unit property and a 284 unit property being operated completely separate, different names, different signs. They had two staffs. The one side, the property's leasing office was in an apartment unit because there was never a clubhouse built on that side of the property. And so by acquiring both of those properties, we were able to turn them back into one property. So now we have 539 units in one property that we manage with one staff instead of two staffs. We eliminated a whole extra layer of overhead, and just by expense cutting and then recognizing where we could drive rents, we were able to tremendously drive market value at this property. So we bought these two assets for less than $40 million a year and a half ago. And we're talking with a lender about doing a refinance. They were talking about refinancing us out for around 40 million at 75 LTV, which puts the value at, like, I don't know, somewhere between 50 and $55 million, which means we created 10 to $15 million of value in 18 months. And I think that's what we call a home run.
Yeah, that's awesome. Did you have any kind of like waterfall like structure on that, or I don't know if you're allowed to, like the home run hurdle, as they say? I don't know if you're allowed to get into that.
Yeah, we do have that home run hurdle. Our waterfall terms, while they may vary from deal to deal, they generally are structured such that the investor gets 100% of the cash flow until they reach a certain level of return. Mm-hmm. And then there's definitely there's usually steps where the split between us as the sponsor and the investor varies depending upon the level of performance. So, you might get 70% until they reach a 12, and then 60% until they reach a 15, and then 50-50 after that, or some minor variation on that same theme, which means that if we do hit a grand slam, then we participate at a greater rate, which obviously motivates us to want to produce grand slams more often than not. And certainly you can't get that out of every deal, but when we do, it helps us get rewarded for that.
Yeah, I heard recently another sponsor we were talking to is like, we don't always look for the grand slams, but hitting a bunch of base hits, really tease you up to that grand slam when it comes. So I thought it was a great baseball analogy. Might have been Bruce Peterson. He likes baseball.
Yeah, it might have been. You're exactly right. I mean, we didn't see this. We saw this as being maybe a solid double.
Yep.
But sometimes the grand slams just come when they come, and you don't know which ones they are, and you certainly don't think that you're going to do it on every one of them. But if you aren't out there hitting base hits, you'll never hit the grand slam.
Exactly. So for our partnership, I'm more of the asset manager, the operator, the hands-on person. So I'm always interested in what other operators' favorite trick is, or favorite go-to technique for increasing NOI by either increasing income or decreasing expenses. Like, what's like the one thing that you're always doing? It's always like the first thing to look at, like your easy trick to bump up the NOI.
Get rents to market. I mean, you can only compress expenses so far, right? Mm-hmm. You can't bring them all the way to zero. You can't cut them in half generally, but you can usually get a little bit of expense savings. Maybe you can get 5% or 10% expense savings, but usually not a whole heck of a lot more than that. So we certainly strive to be efficient with expenses, but we recognize that there's a limited amount of added value that you get by spending too much focus on expenses. Instead, we focus on revenue. And this revenue is what really matters. When you go to the agencies to size up your loan, whether it's your acquisition loan or a refinance, they're looking at your net rental income in large degree. That's going to drive the size and the LTV of your loan. So the more you can do to drive revenue, the more you can do to add value, and that's really where we spend all of our time.
Nice. That's a good note for the listeners. I'll put it down in the outro of that. I'll recap that one because that's a really big point. And that is it for me, Duc. Back over to you.
All right. So shifting gears to the prior round, what is the best book that you recommend other than your own?
Yeah, I've got a couple books I've read recently that I really liked. One of them was called Upside, and it's a book that describes demographics and how to interpret demographics, which is really interesting when you're in the real estate business, and understanding how those demographics will affect real estate decisions. Another one that I liked was called TED Talks, and it was written by the guy that is the CEO of the TED Talk organization. One of the things that we do as as real estate sponsors is we're always raising capital, which means that we're always out there talking to people and giving presentations or speaking at conferences and that sort of thing. So learning techniques to improve public speaking skills is really important, because conveying that message can be the make or break as to whether or not anybody wants to invest with you.
Got it. That makes a lot of sense. So what is the biggest lesson that you've learned over the years?
Oh man. Well, in 30 years, I've learned a ton of lessons. I think probably the one that sticks out the most to me is that there's tremendous power in economic cycles, and you absolutely have to respect how much injury they can cause and not get too hyper excited about real estate and the prospects of, earning big money or getting rich quick or any of those kinds of things. You got to be very cautious in this business and treat this business as a loaded weapon, because a loaded weapon can save your life. It can also kill you, and if it's handled improperly. So we have to respect this business in the same way, because it can also do both.
Yeah, it's a great analogy. So what is your superpower?
Geez, that's a great question. I don't really have much of a superpower. We've got a great team with a tremendous amount of experience, and we're very cautious and conservative, and that's enabled us to be in this business as long as we have. So if I have any superpower, it's that I haven't lost any investors' money in multiple market cycles over a 20 years I've been doing this business with investor money, 30 years in total. And I think that's probably goes further than any other superpower I could think of.
Yep. So for the busy working professional who's working towards financial freedom, what advice do you have?
Well, it depends on how you define financial freedom. If that means that you want to be an active real estate investor and go out and buy real estate, then it's go get your first deal, your second deal, your 10th deal, whatever it is, and just keep after it to keep building up your portfolio to earn passive income. If it means to you that you want to invest passively as an investor, then I think it means you've got to read The Hands-Off Investor to learn how to do that properly and make smart, wise, passive investment decisions, invest with the right sponsors in the right real estate at the right time using the right strategy so that you can build a really solid and diverse portfolio.
Yeah, I'm actually reading that right now, and I wish I had that 2 years ago when I was first looking at these offerings and trying to evaluate syndications. So great book.
Thank you.
So as we wrap this up, how can people reach out to you?
The best way is either through biggerpockets.com. Of course, I've got the book, The Hands-Off Investor, that I wrote for biggerpockets.com. I'm also write some articles for their blog, so you can catch those on the website. I also answer questions on the discussion forum, so I can frequently be found there, or through our company's website for Praxis Capital. The website is praxcap.com, which is praxcap.com.
All right. You've been so generous with your time, and we really appreciate you coming on the show.
Thanks for having me on. I appreciate being here.
All right, thanks, Brian. I told you, Duc, Brian would not disappoint us on this call. Super excited. I have tons of notes for our listeners, as well as for our own practices that we're going to go back and look at a couple things after Brian taught us some new concepts. So one of the biggest things is the importance of having reserves, especially if it's like a recourse loan. I know he's at a level where he's doing non-recourse, but still the importance of having those reserves as sponsors and having that liquidity, because if for his example, when the market turned down, he had to cover the payments out of his own pocket. So if you're not in a position to where you have that liquidity, or your team doesn't have that liquidity to be able to make the mortgage payments, you might not be ready to be a sponsor on your own if you don't have that bit figured out. I also liked his points of vertical integration, right? No company starts at vertical integration. They grow into it, they evolve into it. And as a CEO, like Brian, you have to constantly be looking at your processes, looking at your business and asking questions constantly of, are we being efficient? Can we be more efficient here? If we bring on, X team member, will that make our business more capable? And then also the huge benefit that I didn't know was going with vertical integration for attracting institutional investors. So that's just a huge, huge benefit to when you are making your 5-10 year roadmaps for your company, to be able to hit, okay, five years, we're going to hit this milestone. 10 years, we're going to be vertically integrated, so we can start attracting those large JV firms and really start scaling up and buying bigger product in the market. And to know that institutional investors look at firms that are vertically integrated, we can go back now and readdress our roadmap and our goals to put that as a target on our plan. And that's something that we're going to be doing. Another thing we took away was the going for agency debt. The metric of they're going to be going off of net rental income is one of their biggest indicators for agency debt on determining the size of loan that you're going to get is a huge metric. So now when you're looking for that exit, that capital event of refinancing, maybe you went with community bank and you're going to be refinancing up into agency debt, or if you're just going into agency debt right out of the gate, you can look at that net rental income and see how you can, if it's a property that you're going to be refinancing, maybe a year out, start nurturing that metric and getting your T12 all seasoned to be able to maximize that, so you can get the best terms, knowing that that's a metric that they're going to be heavily relying on. That's going to really impact the loan terms that you get. So that was a huge one. Also, like I mentioned earlier, the buy and watch plan. We have different milestones. We have a 3-year milestone, a 5-year milestone, a 7-year milestone, a 10-year milestone. That, hey, we can target these, but we can be out to 10 if the market deems that right now it's not the best time to sell. You don't want to kind of pigeonhole yourself into a 5-year hold, and at the end of 5 years you're forced to exit, even though the market conditions might not be optimal. You have that flexibility to maybe sell a little sooner if the market gets really hot, and you can get out sooner and return that capital to your investors and make a good profit. Or if the market goes down and we go into a bear cycle, you can hold on for a couple more years and have that flexibility. So that buy and watch strategy was a great takeaway from his new book there. I definitely, for us, I'm big on the asset management side about resident relations. So see his unique resident incentive program of giving the $50 gift cards to residents as they come in and say, oh, I'm going through some tough times. I'm not able to pay rent because for this case, we're in June 2020. So coronavirus, a lot of people have been laid off, and give them that $50 gift card up front to kind of build that rapport. It really strengthens that relationship between resident and property manager and the firm, saying, hey, we're here to take care of you. We're in this together. And then when they start getting back on their feet, they'll have that feeling of reciprocity, and they will make the decision that they were there for me when I needed it. Let me take care of them first, the rent first. So building relationships as well as incentivizing them down the road when they can to pay the rent. And then also the great book recommendations of Upside and TED Talks. I took note of those, and I'll be getting those on Amazon or Audible or whatever. So those are my huge takeaways. Super grateful to have them on, and excited to start implementing some of these into our own business model.
Yeah, super inspirational career that we're hoping to emulate one day. So if you found value in this podcast, please subscribe so you can get the latest episodes. We would love it if you give us a rating review on Apple Podcasts or Stitcher. If you know anyone who might resonate with today's podcast, please share the episode with them. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily and more. And if you're interested in connecting with us, go to tricityequity.com to learn more. See you next time.
All right, see you, Duke.